Jake, just go to YouTube. Just go to YouTube. I don't know what to do.
Okay.
Talk.
It's working.
It's working. You see it on YouTube. It's good.
You're good.
Okay. Can you do the YouTube screen for me as well? Thank you guys um, for your patience. We just had a few technical difficulties. Okay. So now we're live. Jake, can you divide the screen in two for me so I can see both? All right. I'll see trading. All right. Okay. This is it's just overlapping. Okay. 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 Perfect. Yeah, Jake, that's good. Leave it. It's good. All right. So this is good. All right, guys. Listen, thank you very much for your patience. We just had a few technical difficulties. We're trying to coordinate a few softwares at the same time. Put my phone away here, and we'll go from there. All right. Well, again, thank you for your patience. We're going to talk about today about top 10 things that traders overlook. And I look forward to all your comments and participation and questions. So today we're broadcasting on YouTube and on TradingView. So thank you to our friends at TradingView that helped us with all the technical support, and we just opened a channel there. Before we start with the webinar, I just wanted to remind everyone that there's a substantial risk of loss in futures trading, and past performance is not indicative of future results. You have to trade only with risk capital. It's capital that you can afford to lose, and it will not have any impact on your life. Futures trading is extremely leveraged, and use it at your discretion. So before I start, I just wanted to say again to our friends at TradingView who also helped us stream on their channel. I got to know the guys at TradingView, I think close to about a decade ago, and their founder, Dennis, is a very smart individual, very kind individual, and he had that vision of doing things, participation and kind of interaction with traders on the web, and that was his vision, and he fulfilled it. It reminds me when they asked Henry Ford, why didn't consult with people, when it came to building cars. He said, if I consulted with people, they would have told me to build a faster horse. And I feel the same. TradingView with Dennis had their vision, and they fulfilled it, and it came to fruition. So, and it's a really nice interface for trading, nice interface for analysis, makes everything easy. All right, so we're going to talk about the top 10 things that I think traders overlook or they neglect, or things that are in general traders don't speak about enough, right? It's not spoken about enough. So I'm going to start, and when I see your questions along the way, Jake will help me, to point your questions. And if I see them, I'll answer them as well. So the first thing that you have to think about is the question: how many things do you need to really make a trading decision? Okay, so when to short, you have to start thinking, how many variables or how many things do I need to make a decision? There is nothing wrong with having a few decisions, meaning a few tools to make a decision as opposed to many tools to make a decision, because you don't want to be paralyzed in your analysis. I personally think that some people love to add more and more variables because trade, so they kind of justify to themselves that if 50 things don't happen at the same time, then it's not worth taking the trade. But that's not true. You have to make a decision as far as your variables, and you can have all the stars align for a perfect decision, right? There's no such thing as a perfect decision. So minimize it, and then your method you should be able to state it in a sentence. If you cannot state your method in a sentence, then basically you don't have a method. For example, let me give you an example of a method, okay, that you can summarize in a sentence. I like to buy any asset that you trade, right? Stock, futures, whatever the case is, stock options, Forex. I like to buy things that have gone through a big run up or run down, and then basically showing us signs of recovery. So that's a method, because when we have a lot of huge run up, usually there's a lot of FOMO involved, and then the markets crash, and then it could potentially return to the original point. So some of the traders want to capture it. So that's a method that somebody can say they trade. It's enough to say, I'm looking for overbought and oversold areas. That's also a method. But at the same time, you want to be a little bit more descriptive of exactly of what you do. If you have 50 variables, you can't come up with a sentence. You can't come up with a method. All you have is just a bunch of tools to use and nothing to do. And really, it's just there for analysis and not for decision making. So some people love to do analysis, but again, they're not traders and they're not decision makers. Okay. The second point that I want to address is why all the traders make the same mistakes regardless of their IQ. So I'm going to use a few examples here, okay, to tell you this, okay, that when big traders or hedge funds or big investors, when they make mistakes, they make mistakes. There's no such thing as a stupid mistake, and there's no such thing as an intelligent mistake. A mistake is a mistake. It shouldn't have been done from the first place, right? When people analyze markets and when it comes to money, we have a certain DNA that drives us. So regardless of your IQ level, of course, the cell phone has to ring. I apologize. I'm going to close it. I apologize. So this does not happen. There we go. All right. So, okay, I'm back. So again, we were talking about IQ and trading. So when it comes to mistakes, all the mistakes are basically the same. They're just mistakes. So what I was talking about before, that there's different people with different IQ level. Now, when I say IQ level, I don't want to compare people on the fact that somebody's smarter or not smarter, but some people could come from, let's say, a very analytical background. They could come from a statistical background. They could come from some sort of an analysis background, and somebody could come, for the background of being, let's say, something that requires more labor with your hands, like being a mechanic, right? So those are totally two different approaches to life and to analysis and the way they think. Now, it does not mean that when it comes to the market, one is more intelligent than the other. The mistakes that they make, which is fear, greed, FOMO, getting excited, not having a risk management plan, could be absolutely the same. So I'm here to really encourage you and to tell you that regardless of your background, regardless of where you've been in the past as you approach trading, you always have to apply the same thing when it comes to risk management. And again, we will get to that. To answer the question why all traders make the same mistake regardless of their IQ, again, it's our DNA when it comes to decision making that has to do with money and has to do with gaining power or gaining money. It's always the same kind of thought process. Now, trading involves a lot of variables, and part of the variables it revolves odds and psychology and decision making. And when you mix those three together, majority of people who don't have background in that kind of a game make absolutely the same decisions. So again, your IQ, it helps in life. In trading, you need a lot more than that. Okay. 3, what beginners and amateurs do not get about the secrets of trading. Okay, so first of all, there are no secrets of trading. Really, there isn't. Secrets of trading could be used by marketing guys. It could be used, by people who want to sell courses and books and everything else, because there are no secrets. Essentially, trading is a byproduct of decision making. This is how you have to think about it, right? So it's a combination of all your habits and the results. By the way, winning in anything in life, whether it's winning in sport or winning in your, is truly not a secret. It's a combination of your habits. And if you have good habits and you have good discipline, you could potentially have good results. You never guaranteed results. Clearly in trading, you never guaranteed profits. But that's what it is. There is no one variable that would make you successful in trading. It just does not exist. I cannot say that somebody has a better method, a perfect method, a better moving side, a better screen, a better platform, a better math formula, or anything like that, that just based on that one fact, it would be a successful trader. So the secrets do not exist, right? Because when somebody says a secret, he's looking for one variable that would put him over the top. It doesn't exist. Everything is a combination of your habits. All right. Number 4, okay, why paper traders will never lead you to trading success. Okay, I've had this, I would say, I had this discussion with many traders out there, and many people out there believe that paper trading will help them become a better trader. The people who believe in that are paper traders, by the way. So what happened in the market for a very long time, meaning that if they go through all the possible markets and scenarios and everything else and placing live trades, not real trades, but the market is live, meaning it's real timing. I'm sorry, real quotes, not real timing, real quotes. It will give them some sort of an edge when they approach trading. I don't believe in that. Now, should you paper trade? Yes, you should paper trade to get to know the software. You should get to know how to place orders. You should paper trade how to know how mechanically, how everything works mechanically. But it will not give you predictive powers. And the worst part is for many traders out there, and again, I'm not criticizing anyone, that's what intuition tells us. Okay, maybe if we paper trade and we see the markets, and we follow them, it will give us some sort of a gut instinct, how to behave better in real life. But it doesn't. It just doesn't. Anything that you apply in life, you need to apply it in real time, and you gotta have some sort of a level of risk so your brain gets used to it. So what happens many times to people who are paper traders, they paper trade, and then, but then, they could be trading for months, 6 months, a year, or 2 years, whatever the case is. I've spoke to people who did it for 4 years. I mean, to me, it's a waste of time, colossal waste of time. But let's assume that, an average guy out there, let's say, does 3 months, 6 months, and then he approaches trading, right? Well, what happens is it could be is completely different than the environment when he paper traded. That's number 1. Second of all, in a paper trading environment, your fills many times are not realistic. Many times you overtrade. Again, this is my experience and my opinion from talking to people. They overtrade, and when they overtrade, essentially every time it will get them the same feel in real life. So what happens is that they start going for very short increments. Some of them say, for example, my average is a tick, right? I like to trade for a tick. It doesn't work in real life. It just doesn't. It works in paper trading. You go into real life and it's hard to get filled on every order. So and you can trade smaller size in the beginning. Is because what you want to do is get used to a live environment and adjust it accordingly. Now, a lot of people want to avoid the pain of loss. I totally get it. I understand it. I wish there was a way around it while you're improving your method. I know that some people just don't want to hear it, right? Some people just want to put their head in the sand and believe that there's a method that they can paper trade and take it from paper trading to real life and it will work perfectly. And it just won't, right? So the key is to start small, right? So instead of being stuck in paper trading for about 3 months or 6 months, you can simply start small. What is small? Trade contracts such as the micro futures contract. Now, I'm not here to downplay the risk in the futures market, but when you play something like micro, it's 1/10 of the size. So maybe that's a good starting point for you, instead of paper trading, to start playing around with that. After you can paper trade again to get to know the platform, but start building your method slowly with a small contract, not trading it for, and it will give you a better perspective of how the market moves as opposed to being in a mode of paper trading. And the last thing you want to do is, as a real life trader, is not to go back and forth between um, live and demo, live and demo. Now, some people out there who have traded live for many, many years go sometimes to demo to test out a few things. But I believe those people have a little bit of a different perspective and they know how to test things the right way because they've actually traded live for so many years. So they have a totally perspective of the limitations of paper trading. Okay. So enough on that. All right. All right. Next thing. Is there a method for all? Get asked a lot, is there, Matt, do you think there's one method that could trade all the market volatilities, like could consistently all the time would make me money? So I'm going to give you the short answer, and the answer is no. The long answer is this. The long answer is that the core foundation of your platform could stay the same, but the risk and the profit taking could vary based on the market volatility. So, for example, let's say that under a certain situation, you'll have a profit of, let's say, 2 points. When the market is very volatile, you might have a target of 5 points. Again, the core method stays the same, right? The core logic of your method will stay the same. And at the same time, what's the risk management, which is the stop losses and the profit taking, could vary. By the way, when it comes to stop losses, just a legal disclaimer that sometimes stop losses do not get executed at the price that you want due to very adverse market conditions. So you can have big slippage or not get stopped. So that's really my answer to that. So don't be afraid to have one core method and change it according to market environments. I've heard of some people that have different methods, but I don't know if they're successful or not. Some people say I do this when the market is like this, and I do this when the market is like that. But yet I find is really have one core method that they believe in, that they have a method around those numbers as far as the decision making, and the only thing that changes is really the size and the risk management around it. So this is something to think about. And as your system more and you get to know it, you might change it along the way in a number of ways. But when you change methods, just be careful not to just to toss the whole thing away, because that's what a lot of traders do, and that's one of the biggest mistakes that they do. So for example, they could have a method that has been working for a very long time, and then they'll look for a completely new method. That's usually what happens. They just want to throw it all away. But you really have to start thinking, maybe my method is good, but only one variable has to change. So when you change your method, just like everything else, you have to examine one variable at a time. You don't want to just store everything away and start from scratch, because that's not the logical thing to do. What you want to do is start breaking your method into components, and maybe changing one component could possibly tilt the odds in your favor. Okay, now point number 6 that I want to talk about: why full-time trading is overrated. Okay, so let's think of it this way. If I was on, let's say, if I and I've asked people, how many of you guys want to make money? I know that the whole stadium would cheer, right? But let's say that I asked them a totally different question, right? With what trading is all about. I would yell, how many of you want to manage risk? How many of you want to sit all day and manage risk? I bet that I won't get that many cheers, right? Essentially, when people say, I want to get into trading full time, they want to drop their constant income. They want to go into a place where they always have to be in a state of ideal state of psychology, with patience and boredom. And then at the same time, they have to have the right frame of mind and the ability to manage risk all day. This is what the business that they're getting into. So it's not about, I can get up in the morning and do whatever I want. This is not what trading is all about. And people who are really good traders are very modest people, from the people that I've met, and they're constantly in the state analysis and reviewing what they do. It's truly their business. They manage risk for the majority of the day. And so I think that for majority of people, working full time and trading part time could really be ideal. I truly think so. I don't think that anybody needs to get obsessed with this. I want to be a full time trader one day. Well, if you are, sure, great. But there's nothing wrong with trading 2 hours a day or 3 hours a day. You can trade, for example, you can trade in the morning. You can trade the first 2 hours of the open, or you can trade after the afternoon towards the close. If you can't touch it throughout the day, maybe you can trade the night session. Obviously, every session has its own volatility. It has its own liquidity. So you basically, and you have futures markets that are opening worldwide. You have, the mini DEX that you can trade. You can trade the mini Nikkei. You can trade the micros at the appropriate time. So again, when it comes to the trading hours that you decide, just be consistent. Now, over time, you can grow. If things are working well for you, you can throughout the day. But the beauty of part-time trading is that you still have income coming in from your job. So you have really good psychology. And it's really important, right? So you're not just sitting there in front of the screen and you have to make money. You have to make money to pay your bills. You have to make money, for your mortgage. What you want to do is cover, for majority of people, in the first, I think that you should really have all your basics covered, trade with risk capital, and as things progress and you learn and you grow, you would be able to essentially you would be able to increase the time. Now, I even tell people from my people that are customers and everything else, I love trading. I love making trading decisions, but I also enjoy talking to people. I also enjoy working with my team at Optimus Futures. I enjoy interacting with them. They're intelligent guys, and we solve problems. And that's also a challenge for me that I love to do. So again, don't feel pressured. I feel like in the media, there's this that everybody's just being thrown in their face all the time, this advertising of being a full-time trader, right? Take it easy, trade it whenever it's convenient for you, and it's absolutely fine. Okay. Seventh question. Okay, why traders who think they are not gamblers are the biggest gamblers. So not a question, a little bit of a statement. So a lot of people say, I go to Vegas. I don't enjoy Vegas, right? So I'm not a gambler. Well, let me tell you this. If you're going to Vegas or not going to Vegas, that's not what makes you a gambler. A gambling thing is an addiction, it's an obsessive behavior, and it has a very negative connotation. I understand, but sometimes your boredom sitting in front of the screen of doing nothing, right? Sometimes there are no opportunities, but people feel bored and they see this thing moving in front of them up and down all day, and they want to take a decision, right? They want to take a chance. So essentially, they go in and they start trading, and then they add money to losing positions, and that's gambling in itself. Because now you're gambling. You just start throwing more contracts and more contracts, trying to recover a loss. And from a small loss, you turn it into a big loss. So you could be a gambler without going to Vegas. The facility itself and attending it, it's not what makes you the gambler. What makes you a gambler is when you don't have a good behavior associated with your trading. When you take positions that you shouldn't take, when you're trying to follow a group on Twitter or a group on any other social media that all of a sudden went long and you don't want to miss out and you go long as well, or you read there's a good investment, you don't want to miss on it, you jump in, right? Not doing much thinking. So gambling to me, a lot of it is a spontaneous reaction to things without much. So you could become a gambler in trading, right? You could become very spontaneous. So it could happen. So again, I'm never saying those things to put anybody down. I know a lot of people are probably sitting there saying, yes, I have done that. I'm very familiar with this kind of behavior because I've done it, which is great because now you can fix it. Now you know it's not. If I'm talking about it today, it means there's a huge group that does it. Okay. Next point, the nonsense of proprietary indicators. All right. So I spoke to a friend of mine, and he's starting his PhD program. He's way younger than me, but he got into the PhD program. We got to talk about math, and he said, the real math that you study starts really only at the PhD level. That's where the real math. So whatever you study in high school and then in college and everything else is really basic math, right? The real math starts when you get to that level. Now, why am I telling you this? There are indicators out there that are math driven, and the someone of a level of PhD has worked on them, and most of the time, again, in my opinion, they could belong to it's a trade, maybe it's a patent. I wouldn't say a patent, but maybe it's some sort of a protected proprietary mathematical code that a firm may own. However, in the retail space, when people say, they have a proprietary or they're being sold proprietary indicators, the one thing I would tell you is this: there's no such thing as proprietary indicators, because if it's a combination of a number of indicators that are a result of technical analysis, that's what it is. Now, a lot of people, buy those indicators thinking that trading is about the entry point. So if the indicator would give them some sort of an entry point, that's what's going to make them successful. No, what's going to make you successful is really the managing of the trade. The trade management itself, in my personal opinion, that's what makes a trader successful. So proprietary indicators are just combination, could be, of other indicators put together, and then they're displayed on the chart. It could be a combination of signal that is a combination of, let's say, RSI, MACD, and moving average. Just throwing it out there, right? Just making it up. But that's really what it is. And the problem when you follow those indicators, or when you buy those indicators and you don't understand their logic, right? You really don't know how to use them. When you start building your own tools, when you start building your own indicator, you have to be a coder. But when you start with technical analysis, you will understand the weaknesses of the things that you are looking at. That's the beauty, right? If you have a bunch of proprietary indicators and they didn't make you money, you just don't know why, because you don't know what's inside. You don't know what are the strengths and weaknesses of every single ingredient that was put in that recipe, and it's very important. So what I'm trying to say is that, build your own, right? Build your own. Look at the technical analysis. You can pull from the technical analysis tools variables. You can look at moving averages. You can look at MACDs. You can look at see what it does and play around with it, and it will give you an idea of the strengths and weaknesses over time of this indicator. All right, so number 9, one rule that can change your trading game. Okay, so I would say, so basically, I want to tell you, this is not, going back to question number 3, this is not a secret what I'm about to tell you here, right? So this is not big difference. So if somebody asks me, Matt, what do you think is the most important thing in trading? I always say it's the size. Clearly, when we start trading, one of the things that we want to do is max out every single opportunity that we have in the marketplace, right? That's what we want to do. However, is that if you are making mistakes with very big size, you do not have a chance of time to continue trading. It could be a game over just with a small number of trades. So trade to the smallest unit as you can as a trader. I'm not talking here about frequency. Some people can trade 3 times a day. Some people can trade 30 times a day, 100. What I'm talking about really is the size of the trades that you make. And that, in my opinion, will make a very, very big determination of the size. If you, I'm sorry, of your success. So if you look at money managers, for example, like commodity trading advisors, right? So those are licensed professionals. And basically, they have a track record because they manage money for other people. So one of the things that I'll take a look at when I deal with professionals like that, it's called margin to equity. How much capital was used to generate the returns that are on the books? Now, if somebody has amazing returns, let's say, I don't want to put a number, but let's put a different number. But let's say those are very good numbers. Now, if they used just a small portion of it, like let's say 20%, that's great. If they use the whole capital all the time in terms of margin, then you understand they have high risk and high reward. So what you want to do in your own trading is really minimize the size and max out. That to have above average returns, you should not you do not have to max out your entire capital. That's what I've learned, right? So I learned that those people that are patient and they trade with size, they're looking more for consistency as opposed to, home runs. And having said that, talking about size, just reminding you again that there's a substantial risk of loss in futures trading and past performance results. If I had, again, just one sentence to say, if somebody says, Matt, just come on the podium and you have basically 30 seconds for, for a seminar, I would say just trade with reasonable size. That would be it. Because all your knowledge in the world of trading or trade every single time, maxing out the trade or maxing out your capital. The minute you're in a trade, you don't know the potential of the trade. Now, some people think that this business is about predicting prices. It's really not. It's not about predicting prices, right? This business is about managing risk. If this business is about managing risk and not predicting the future, because don't think for a minute that somebody out there has a better predictive power than you do when it comes to the future. Get it through your head. They don't have it. It's just like the weather. The weatherman tells you at night it's going to be sunny. You come in the morning, it's raining. Where's my umbrella? Where's my boots? That's trading. That's exactly what it is. And how you manage that risk, then it's up to you, right? So essentially, control the size, because if you don't know the future, regardless of how good you think your signal is, the minute you're in the market, your signal is gone. It's gone. Whatever led to that point doesn't matter. Now you have to manage risk. Managing risk with small size is much easier than with a big size. It's like coming to the airport with being by yourself and having 8 suitcases, 4 in each hand. This is what you're actually carrying as a trader, and that's exactly how it looks like by the time you come to the counter, right? You're a mess. So size does matter, and I can't emphasize it enough, but I hope you get it. Okay, number 10. By the way, before I get to number 10, do you have a okay? All right. Okay. So number 10, which activities help you? Which activities help you become a better trader, right? So let me answer that. Get into anything that requires a habit, right? Get into anything that is consistently a habit, hoping that this habit will basically spill into your trading habits. I'll give you an example. Let's say that you decide to run 30 minutes a day. Every day, or 5 times, let's say a week, you give yourself 2 days off, you run 30 days every day, right? That habit, once you do it for 3 to 6 months, will eventually spill into trading. Physical activity. I love to read books. Love it. I dedicate every day 30 minutes to an hour to reading, sometimes more if I have. It's a habit. It gives me ability to think. Some things that I read are very inspirational, so it makes me think. That, again, that habit spills into trading. It is very, very hard to make trading a successful field in itself, right? It's very, very hard. And what I mean by that is that if you're in the business of trading, there are probably, and if you're good in trading, there are probably other good things that you do from a habitual standpoint. I don't believe that good traders in themselves are just there in itself. Either people come from a very structured background, and they already have it in them, the discipline, that they've done something that requires discipline for a very long time, or they're athletes, so they've required some sort of a physical ability to stay in a certain constant state of health, and that's also habits. So essentially what you want to do to become a trader is not just be obsessed with trading one day, right? Because sometimes I see comments, public comments such as, I looked thinking about it and that's all I want to do. I just can't stop. And then they go to Amazon and they buy 50 books about trading and thinking that's what's going to make them smart. And then they open, a demo account and they just jump into it, and that's it. You have to be a little bit slower in your way of thinking. You have to develop very good habits alongside your trading. Sleep is physical exercise is important. Reading, dedicating time to analysis is important. Even the fact that you go and you analyze your trades after the market makes a huge difference in your habits. It's a huge change, right? Sometimes people are like, okay, I won today, I lost today. They're done. Spreadsheet, or review them, or go over their P&L, or they do market replay and they see how they traded in those markets. That's a good habit that they developed alongside trading. So don't think for a minute that you can only succeed in trading as a field in itself. Other things have to come with it. Okay. Any other questions? And again, I'm sorry for the delay. I know there's a lag. I apologize for that. All right. Okay, so one of the questions that I have here, do you advocate recording trades in order to play them back and review them? 100%. What you want to do is use market replay and go over the trades that you have done, because it will give you a better perspective of the context that you've traded, and whether it was a good trade or a bad trade. You will decide whether it was the right thing to do. Now, here's the thing, when you go over your trades, just because they were losing trades, it does not mean you made a bad decision. So be very conscious of that, right? So when you go over your trades, the important thing that you want to do is see if you traded along with your plan, right? If you traded with your plan and the market did not, there was you didn't make money on the trade, it does not mean that it was a bad trade, because trades have to be judged on many trades, right? So you need a large sample of trades to decide whether the method is working or not. So one of the mistakes that amateurs do, and by the way, thank you for asking this question. One of the mistakes that traders do is that they sometimes review the trades throughout the day, but the trades that didn't make money, they think they're bad trades. I could tell you this, that you could have a day which is wonderful and you've made money that you made was bad. So the market was good to you that day, but trading that way in the future will not be consistent. So yes, I do recommend to review your trades, looking at the context that you took your trades, analyze why you did your trades. Were you spontaneous? Did you follow your plan? Did you follow your energy? Right? So imagine this. Imagine you review every day the 10 trades that you did. Let's assume you trade on average 10 times a day, or 20, whatever the case is. So let's say you review the 10 times and you're starting to see in the long run that you make 7 mistakes, but you're able to get out on time. But the 3 trades that you do make actually cover for the losses. Now you have a good method, right? Now you have something that's working. Right now, okay, the 7 trades that I make, is there anything there I should do, in order, to improve my method, right? You look at one variable at a time. Remember what we said, right? So that's very important. So yes, review your trades, but analyze them in the right context. Okay. Next, okay. Often focused on what they need to do in order to get better. In reality, I think they need to put focus on eliminating the things that contribute to their bad behavior. Okay, so somebody made a comment here that in reality, traders need to focus on eliminating things that contribute to their bad behavior. It's very hard to know bad behavior. It's a very subjective thing. You really have to kind of have very objective thinking about your subjective behavior. It's tough. It's not easy to eliminate bad habits. They're not always very noticeable. And sometimes to be conscious of our bad behavior, you have to understand how decisions are being. Now, by the way, a lot of the books here that you see in the background are not trading books. They really are about decision making. I love reading about decision making, and it helps me understand my own brain, how I analyze things. So I don't disagree with the statement that traders should eliminate bad behavior. The challenge is really to spot it when you do it, and realizing what's a bad behavior and what has not played well for you. So again, bad behavior is not always judged based on the results of the trade. Right? So just remember that. All right, thanks. Can you say something about preparing for the day's trading? Sure. So what you want to do is maybe when you finish trading, is take, obviously eat your dinner, take it easy, maybe work out. But what you want to do is go over today's levels, right? And then what you want to do is think about what will happen if those levels hit tomorrow or new levels will hit tomorrow. You have to ask yourself the question of what will I do then, right? Here's how a lot of turn off the screen at the end of the day. And by the way, anything that I'm telling you is not criticism. It's an observation. It's the reality. If everybody was perfect in trading, we wouldn't have this seminar, online seminar. We wouldn't be talking about it, So again, not coming from a place of looking at you from above, but really talking to you as equals. But majority of people close their screen at the end of the day, and the next day. And what happens is if they didn't think about the new levels that the market will hit, whether on the upside or the downside, they are more susceptible to spontaneous behavior. So if you think about the market levels the day before, let's assume something is trading at 10. Any asset, doesn't matter what, right? Something is trading at 10. That's where the market ended today. You have to think, okay, what will happen? What will I do if it reaches 12 tomorrow? Will I buy it? If it reaches 14, will I buy some more? If it reaches 16, will I buy some more? Same thing you have to think about, okay, what if it hits 8 tomorrow? Should I buy or should I go short? 6, should I buy? Should I go short? So again, those kind of decisions, looking at price levels the day before, the price levels that you traded, your targets, think about, what will happen if they hit the next day and other prices. What will you do during the time, right? If you do that, you're not going to get yourself caught in some sort of a spontaneous behavior because you're prepared. You're like, okay, I know if it reaches 12, the market is strong. I got to buy it, right? Again, it doesn't guarantee that it will go up, but at least you'll know management that will come with it. So remember, the business of trading is not about predicting the future. It is being organized, and risk management and habits, right? And that's a habit. Now you know what you're going to do when this market is going to hit. Now, clearly, I know that many times beginners, even though they promise themselves that they don't do that, and they leave because of fear potentially. But that's a different story. Over time, if they continue doing that and they trust themselves, they will start seeing that if their method actually works, they will have more belief in it, right? So I hope that helps. Could you speak having a plan for each trade? How much? Okay, so somebody said he came a little bit late, and the question is, how much are you willing to lose? Profit goals. Don't get emotionally invested in a trade. This is a very generic question. It's a good question, but it's a generic question. It's one of those questions that are so individual. Right? It's like somebody's asking someone, what do you think the best moving average is for a day trader? I don't know. What do you think the best time frame for a day trader is? Should I look at a 5-minute chart or a 10-minute charts or 15? I don't know. So I'm not trying to avoid your question here. I just wanted to say that it's very, very individual. The one thing I would say, how much are you willing to lose in the volatility of the market? Those are totally two different things, right? So if the ranges are very high, you have to be willing to lose more. If you're not willing to lose more, then you shouldn't trade. If the market is very narrow, then you have different expectations also of a reward. So again, what you have to do, rather than ask the question of how much you're willing to lose, you're probably looking for me to give you a number, right? Or a percentage of equity, right, that you're willing to lose. But I think many times those numbers are actually very random because they're not in tandem. You could say that, but if the market volatility is very high, then essentially you're going to get triggered every single time. Maybe you need better risk management, and you have to be willing to sacrifice or willing to lose 3x because the market is just x that way, right? That's what it is. So again, it's a very generic question. It's very individual. I would tell you that whatever you decide to sacrifice on any single trade should be a reflection of the market volatility of the market that you trade. Now, you can trade the same market in different times. You might have to have a different willingness to lose, different number. So let me give you an example. Willingness to lose $200, and the market is very volatile in the same asset class that you trade, you should be willing to lose $500. I don't believe that it's a fixed number every single time. Now, potentially you could have periods that every day could be 200, or other periods every day is 500. But again, you have to measure the volatility in the ranges of the market that you trade. There are a lot of indicators out there that could measure volatility, and I suggest you explore that. Okay. Not specific amounts, but the importance of having a plan each day. I see many traders who keep moving stops away so they don't get hit, hoping the market will turn. Well, as I explained before, somebody's mentioned here that there are traders, what they do to keep on moving their stop losses lower or higher if they're short. I'm very familiar with this behavior. It's a pure gambling behavior. It's absolute. It's a strategy that relies on hope, spontaneous decision making. I would not recommend anybody to do that. Nobody wants to be, in the position of a loss, but things like that turns a small loss into a big loss, and then it's game over. So again, you're in the business of managing risk, managing your emotions, managing your habits. And if this is the habits that you developed of moving stop losses away from their original point that you planned, then you really done nothing. Now, again, it's an art. It takes a very, very long time. But at the same time, again, I think that beginners don't understand that many times even the best of traders get stopped out many times. It happens, right? They just accept it as a fact. They know that the markets will not play in their favor, and they continue to the next trade. When you start having bad habits, and this is just one of them, of moving your stop losses around, it means that there's a lot of other bad habits that are probably there, from including spontaneous entry and gut feeling, and then placing a stop loss based on the gut. So it's just a combination of bad habits. It's not like a perfect plan, and then just your risk management is off. It's probably when you move stop losses around, your entire plan is off. So okay. Okay. So okay. So Verillo here says that one reason the trading is hard is the large amount of noise that is literally all around. cutting noise is important. One thing is the disconnect from the dollar numbers on your screen. I do agree. I do agree that we are surrounded in a world of noise, irrelevant noise, and you don't know who's competent and who's not competent, who's teaching or has really the knowledge behind, or if somebody is just, um, producing videos from his mom's basement, teaching you how to trade and wants $100 a month for the subscription. It's hard. I get it. It's there is a lot of noise, absolutely. So there's the noise of influence, how to trade. Then when you trade, news outlets are not in the business of sending news anymore. It's all about content, more content, so they more numbers for advertisers. So the numbers are not there. So the news is not there to really to be informative. So yes, I totally agree that you have to completely eliminate the level of noise out there. When you trade, you got to have a very deep focus on the markets, very deep focus. Trading and listening to someone, and then there's the news is blaring, and then there's the radio in the background, just enormous amount of noise. Basically, it doesn't give your trading any depth. When you trade, when you make decisions, you really want to focus on those decisions. You want to absolutely, I agree 100% that you have to um, eliminate noise. Now, the second comment was that some people, when they trade, they don't look at the dollar amounts that they won or lost because they don't want it to mess up their psychology. So they only look at ticks lost and won, and they just want to continue following their plan. And there is something to it. I can't be against it because I know that if there's losses accumulated throughout the day, psychologically, it's very hard to continue trading. Sometimes your plan, but that's what professionals do. Sometimes they just want to be disconnected from, the actual dollar sign that they trade. But I still believe that they still know where they stand. So whether you decide to adopt this method is up to you, but I'm not against it. So somebody says, can you say something about spoofing JP and Morgan? Morgan just sold it for 1 billion. I don't have any comment on that. All I can say is that focus on things you can control. This is life. There's things that matter and things that you can control. On when those things come together. When you have other things such as spoofing and HFTs and all those things, they have, I mean, yes, they could have influence on trading, in a day or two, or there's some trades here or there. But you have to remember that all those guys don't think that they deprive. It's not an ethical behavior. I don't condone it. It's not ethical to spoof. There's CME and any exchange has very specific rules about it. But essentially, I truly believe that, if things that you can control, don't be concerned with that. So that's all I have to say about that. Maybe about predatory behavior in general, no comment about that. Somebody said, Matt, stick to the YouTube presentation. Okay. I'm done with the 10 points of the presentation. I'm actually, just giving you a chance to ask me questions. So one thing that I wanted to tell, I produce a podcast daily. Jake would list it on YouTube. And you should really listen to it on a daily basis to give you a little bit of I try to have a little bit of a different perspective on trading. Somebody just asked, why do you believe in having a certain What do you believe in having a certain amount of loss and gains for the day? Um, Loss, definitely, you should have a plan. You should not have a plan for gains. If you have a good day, you continue trading as long as the day is good. If you turned a profit into a loss, it can happen. It's part of risk. If the method is working, you continue taking the trades. I don't believe in those people who say, "I just want $200 a day. This is all I want." It's nonsense. You take what the market gives you. There's days that the market doesn't give you. There's days that the market gives you. And when it gives you, and your method is working and the market is playing in your favor, you keep trading until the market shows you otherwise. Again, that's only my opinion, right? It's my opinion. So, okay. So I have a podcast that I do. It lasts anywhere from 10 to 15 minutes. I try to bring real life examples of trading, and you should listen to it. Jake is going to post it here. In any case, I wanted to thank all of you for coming. If you came a little bit late, I know that YouTube is going to post this video, so you will be able to look at it from. If you have any other questions here, I'll stay. I could stay maximum another, I would say, 10 minutes, 15 minutes, and allow you to ask me any question out there. And if not, we're going to just finish it. So I'll just wait for your question to come. All right. So I see that there's no more questions. I just wanted to thank you for your time. Um, and you could do that. One thing I wanted to tell you is basically that you could always ask trading questions on community.optimusfutures.com, right? Ask me about questions. Don't be afraid to ask me any questions. Now, as you see from my attitude, I'm a very straightforward guy. I'm not here to promote trading to anyone. I'm just here to help those who are in the business of trading, who are basically taking risks every day in their accounts. And I absolutely admire you for that. I understand that it takes a lot of courage to do that. So go on community.optimusfutures.com and ask me questions that you have. Somebody's just asked me right now, what's my setup? Rather than starting going into setups, that should be a discussion in itself. In future presentations, what I'm going to do is actually go into certain technicals of setups. So I'm sorry, I'm not avoiding your question, KB11111169. I'm just, I just think it requires, a lengthier discussion. So I promise you that I will do it in future presentation. But one thing that I wanted to tell you is that, I don't have magical setups, right? In your own way. One thing that I wanted to tell you, there is a setup and then there's a follow through. So you want to distinguish between the two. You have a setup that occurs and then a follow through that occurs. And when the follow through occurs, that's when you take the trade. Somebody says, what is the best and the worst things about being a broker? Nobody really asked me that question before. The nice thing about being a broker is basically you get to know a lot of people and you develop friendships with people. So even though some traders are and maybe I won't get to see any of them. I meet very interesting people in this business. When they choose Optimus Futures as our brokerage, I'm very privileged. And basically, I love helping them. And they share their experiences with me. So, that's, I would say, one of the nicest things out there. It gives you the ability to communicate with people from different aspects of life. Um, the challenge of being a broker is really time management, right? Um, that's really what it is. We You have to manage your time right. Our technical support has to manage your time right. People expect things to be done in a timely fashion, and it's a demanding job. It's a demanding job also, managing sometimes people at times that might have too many positions, or there are margin calls that could occur. Because we are regulated brokers as well, there's a lot of reports, that we have to write. Well, not so much write, but we have to keep files. So that's basically also part of the day. So there are challenges. Enjoy it. I like it, and that's basically it. So, somebody asked how many clients we have. I definitely not going to answer that, but we have many, many clients. Um, so, is it special that a CEO of a brokerage is talking directly to clients? For me, since I built this company, I'm surrounded with really good people. My staff are intelligent and smart, everything else. But from the minute I built Optimus, I was always a broker as well. So, CEO for me is just a title. I hope that I get to be good at what I do as a broker and help people and manage my team. And that's really all I want. I want to manage my team right and head people in the right direction, and also push our traders in the right direction. I know that not every single customer on this presentation will end up with us. It's fine. I understand it. Some people may love their brokers. I'm trying to earn people's trust, because what I want to do is basically give them something that others do not. We can all go into the business of we can go into the business of competition against other people, but then it just becomes then we just become software salesmen. All right. So a lot of people start asking very specific questions. How many brokers are traders? Just wondering. Don't know. A good broker does not necessarily has to be a trader. Some brokers just set up their customers online. They're nice people. They don't know much about trading, but their concern is just to put somebody on a software. We do that. I try to add the little extra, but majority of brokers are not traders. A broker's job is not a trading job. A broker's job is he has to be licensed. He has to carry his license in a good way. He has to have carry it in good faith, because we're regulated, but they don't have to be traders. Some licensed people become, money makers, such as commodity trading advisors. But again, then they manage money. They don't manage brokerage. So I hope that's basically answers your question. Anyway, guys, this is it. We're reaching here at the end. So I wish you all the best. Thank you very, very much for coming. I appreciate you listening. I appreciate all your questions. Again, if you go to community.optimusfutures.com, would love to hear your questions. So thank you, KB. KB just said that I'm the only broker that he ever spoken to. Hey, good talking to you as well. I'm happy that I'm the first one. Second thing, go to our site. Go to www.optimusfutures.com. Since many of the guys who are actually on this show, just to let you know, we connect to TradingView to trade futures through CQG, and Forex through Oenda, so we can help you with that. We also have our own trading platform if you want to trade. It's called Optimus Flow. so we can help you in any way that is possible. And again, thank you for attending, and I wish you nothing but the best. I look forward to corresponding with you and helping you in any possible way. Hello? Hello?